Hello and welcome to this month's edition of the Unio Market Update. My name is Ger Fitzgerald. I'm not joined by my colleague Alex Kinslett this month. He's on leave and will rejoin us next month. So looking at equity markets, global equity markets for the year to date are plus 14.5%, driven higher over the month of August on the back of a number of contributors. Those notably being the resilience that we've seen on corporate earnings results, continuing to support headline equity numbers. And part of that has been, I suppose, the dominance in the news of all things AI and its potential contribution to not just corporate revenue and profitability and ultimate efficiencies, but I suppose the wider global economy and what AI can do. And on the back of, I suppose, that being championed of late, we've seen that coming through on headline equity numbers. Other items of note are the likes of headline inflation. It's reducing, and obviously investors are seeing that as a positive, and ultimately how that will drive central bank policy decisions. But also, if you're looking at some of the economic data coming through, and most notably in the Eurozone of late, we're seeing a weakening of that economic data, and a turning point in, I suppose, labour force participation rates. And that is seen as a positive within equity markets. Yes, it is bad news, but at the same time, it's been championed because of the fact that the view being that these negative numbers will help or will contribute to central banks being able to say, we're going to pause our interest rate cycle, or we're going to look at reducing interest rates because of the impact it's having in the economy. And equity markets have rallied on the back of that to plus 14.5%. From an emerging market perspective, the picture is a little bit more sluggish. We're seeing emerging markets at plus 4% year to date, actually suppressed somewhat by the performance of China over the year to date. In fact, if you were to strip China out, emerging markets are actually plus 8% for the year to date, which in itself is a strong return. And we're seeing the likes of India really emerge as one of the economic powerhouses now of the emerging markets. In fact, if you were to look back over the last 5 years, you would have seen that emerging markets have delivered a strong return, but India in its own right has delivered plus 10% annualized over that 5-year period. Moving on to inflation rates, if we were looking at prevailing or headline inflation, the news story is good. We're seeing headline inflation reducing. But if we're taking a more medium-term outlook on it, if you're looking over the next 5 to 10 years, what is actually happening within developed economies? We've charted the 3 economies, the UK, Eurozone, and the US. And we can see at a headline viewpoint here that inflation expectations over the next 5 to 10 years are saying that inflation is going to remain elevated. We're seeing that pervasiveness of inflation coming through over the longer term. For instance, Eurozone inflation expectations over the next 5 to 10 years are annualized at 2.6%. That's well and above that 2% target that the central bank have in their mind. So whilst headline inflation reducing is a good item, if you're looking at the persistency of inflation within the medium term, we can see that we haven't seen the reduction, I would say, in the medium term inflation that central banks would like to see. Something just to keep an eye on. Okay, for the month ahead, I suppose one of the items, we're all back at our desks after our summer breaks, and this is obviously going to impact markets as well. You're going to see the impact of increased trading volume, improved liquidity in the markets, which is a good thing. So certainly something to drive the likes of equity and bond markets over the next little while. Central banks, they're really at that pivotal point now, or that crossroads, as to what they are actually going to do going forward. And we're looking at the likes of the Eurozone making an interest rate decision on the 14th of this month, and the US on the 20th. And ultimately, taking into account headline inflation numbers, their respective economies and labour force participation, do they pause their interest rate cycle and see how things go over the next couple of months? Do they pivot? Actually, their view on their respective economies is over the short to medium term is negative, and they take that as a view that they need to reduce interest rates. or ultimately do they just press ahead and be of the view that headline inflation is still sticky, is still pervasive, and bearing in mind that medium-term outlook, they need to commit to higher interest rates for that bit of a period longer to ultimately help the economy in the longer run, irrespective of the potential damage or shocks it causes by GDP or the unemployment rate over the short term. Okay, so lots to consider over the next month. We look forward to speaking to you again. Thanks very much for joining, and have a good day.